Hey guys, this is Losada with Simple Option Strategies. The audio may be a little off today. I don't have my regular stuff to make these broadcasts, so apologize for that. Hopefully you can hear me good, and we'll get started here. So today I'm going to talk about how to manage an SPX zero DTE trade. I've been trading these for over a couple of years, and it's no less easy than when, well, after I started a little while. But what I'm going to be covering today is, all of the aspects of a zero DTE trade and basically my trade plan and some of the risks too that you need to be aware of. Okay, so with that, let's start with PDT. PDT is it's a pattern day trader. Restrictions based on an account that's under 25,000. Okay, or I could say not just 25,000, but 25,000 of usable margin. If you trade futures in the same account, they basically block out the futures to take that into account. So you have to be careful with that. In any case, let's talk about PDT real quick, just to make sure that everybody understands what it is and what the alternatives are to avoiding this, because there could be some heavy-duty restrictions if it happens. So let's define it first. Really, what it is, it's the buying and selling, or selling and buying of the same security on the same day. And initiates in trades, and you can't do this more than 4 times in any 5 consecutive day period. All right. TOS will kind of keep a timer or the number of trades that you do, so that you're aware when this happens. Okay, and so what can actually happen if your account is below 25,000? You could be potentially, and this is the worst case, right, restricted to only selling securities, and that's for 3 months. Okay, so you don't want to fall into this area, and most brokers will give you, get out of jail free scripts here for like 3 times, but you don't, you want to watch this, and you don't want this to happen to you. In case you are, and most traders really are trading, less than 25,000, and so you want to be aware of this. Okay. Okay. So you don't want to be flagged as a PDT account, and how do you avoid this? Right. For number one, if you're trading zero DTE for the SPX, it's mostly 3 times a week. Except for under certain circumstances where there's extra days given, like end of month, end of quarter. If those fall like on a Tuesday, there'll be 4 zero DTE days. For most stocks, it's really on Friday that they have it, but SPX it's at least 3 times a week. And even when there's holidays, they'll bump it over to an extra day. So you could get a Monday off, and then you have zero DTE on Tuesday, Wednesday, and Friday. Okay, so you still have 3. All right. So how can you avoid this? You can limit trades to one a day for 3 days in the week. Okay, you can do both sides, but you have to be careful. Again, if you close one side, that's you're opening and closing a trade, so that counts against you, right? It gives you 1 day trade. Even if you open on Iron Condor, let's say, and close one side, it's still a day trade. Okay, so you have to be careful with that. And if you close both sides, it's 2 trades in 1 day. So understand the rules and restrictions, and you'll be a more educated trader and know how to manage it. Okay. The other way to do this is to manage from multiple accounts. So if you trade in one account and then trade in another, on varying days, right? You won't have, and you close these trades, you won't have the same amount. You get basically double the amount of day trades if you do it from 2 accounts or more. Okay. I know a lot of people who trade the regular margin account and then IRA accounts. They switch simultaneously there. Okay. You can trade wide iron condors, and we'll talk a little bit about that when we get into the into the trade plan. You can trade wider iron condors, and the risk is, you have less risk of having to close the trade and allow it to expire. Okay. And then the other way to do this is you can trade future spreads. Okay. Spreads on futures, and they're not subject to PDT restrictions. Who knows why? It's basically the same thing, and it's just another way to avoid that. All right. So let's get into zero DTE, and if you want to ask questions, just put them on the side there, and then I'll try to answer them as we go along here. Okay. All right. So let's talk about the entry first. Okay. Now, I generally enter a trade within the first 5 or 10 minutes. And the reason for that is because the implied volatility is really the highest during that period of time. And so, so you take advantage of that volatility because once that volatility decreases throughout the day, basically the premium price shrinks. Okay. And so generally you want to try to get in during that period of time. However, during times of higher volatility, it may make sense, right, to wait for the market to establish direction. Now, lately we've had a range-bound to down market, and it's really good for iron condors. And so if you get threatened on one side, the other side is good. And I mean, but with higher volatility, things happen, and especially when we have news-related events, which we've had a lot of, right? With all this stimulus talk, markets go up, markets go down. Just yesterday, we had, I entered a zero DTE, and it was a put spread, and the market went up. It was doing great, and then all of a sudden we tanked. The market went down, and that happens. And so you wanna not be so confident in your positioning. Just always watch and manage it according to your trade plan. Okay, and we'll talk a little bit more about that. All right, so I trade 10 wide with spreads. But I know that there are many that trade 15 and even higher, right? 25 or 50. And I know, most of you know Tammy and others that trade these a lot wider. And it gives you, what it does, it gives you less risk as long as you're trading based on the same premium amount. Okay. So the shorter width spreads, 5 wide, let's say, it really does kind of require you to have more of a understanding of the market direction. And so in those cases, you can trade those, but it's probably better to wait on those. However, the risk is that the longer you wait, the closer to the market you're going to have to be with your spread. And that increases risk, right? The closer you are to the market, based on the expected range of the market, you're going to be at higher risk when you're trading shorter width spreads. So, my recommendation is that the wider that you can go, the better. However, if you get into the real wide ones, and you get a market that's really aggressive and moves into your threatened position, you're gonna be looking at a much greater loss for the distance of the market, just because that spread leaves a lot of room in there for a larger loss, right? So it makes sense. 5 wide, the max risk on a 5 wide is $500 per contract, and for, let's say, for a 25, right, for one contract, it's $2,500 for the same risk on that one contract. And so if it gets closer, you're going to have a larger loss, or managing a larger loss if you're getting that close. So things kind of work together in that way. You give up something and you take something in return. Okay. All right. And a wider spread with additional distance allows you better to trade iron condors, rather than trading one side of the trade just using one spread. All right. Premium should be between 35 and 70. Okay. Now, this is what I generally, I usually get in around 45 to 50, around that range. Sometimes I've gone higher, sometimes I've gone lower. There's a difference between call credit spreads and put credit spreads. And the difference is, and this is a good time to talk about it here, is that you're going to get greater distance for your put credit spreads than you are for your call spreads. Especially in a bull market, you got to really be careful with call credit spreads, because they're going to be, number one, they're going to be closer to the market just because of the way that the premium spreads are devised, right? Generally speaking, the market goes up. However, when it does go down, it goes down much more aggressively. Okay, and so that distance pretty much means nothing, right? If your position's being threatened. Now, and we'll talk about exits here in a second, but I just want to make sure that I cover all of the risks and variations on these and how you trade them. The way that you can leverage them, if you have and this again, if you don't have PDT to worry about, and I've done this many times, is if you have a market that's moving in one direction aggressively, okay, you can actually either close your spread and open a new one in the direction of the market, or you can basically roll it to gain additional premium. Okay, it's just one way to leverage it. And I trade with guys that do that a lot. But remember this, is that as the market, even in a market, well, a market that's going down, right, will generally, implied volatility will go up during those periods of time, especially if it's moving aggressive. And so so you have a good advantage when the market's moving down. Now, when the market's moving up, your premium's not going to be as great. And what happens is that volatility decreases as the market moves higher. And so if you want to leverage that trade and say roll it up, right, you're going to be much closer to the market than you would be when the trade is rolling down, it's moving down, right? Just kind of things to keep in mind as you're trading these things. And honestly, I can tell you all these things, but until you get into the market and you really feel it and understand how the premium works and you're looking at it, right, you're not going to have that experience for how to manage these things quite easily. And so it's challenging at first. And as I said at the beginning, it's in the end, you know a lot of things, but the market does things, and you just have to be aware of what to do when the market does what it does. Okay, because it's going to go against you, I guarantee you, when you start trading, and you want to know what to do when that happens. All right, so let's talk about take profit. I've changed this a little bit in my trade plan, because when the market opens and you've got that nice chunk of premium, and then things settle down, the premium goes down pretty quickly, and then by noon, basically, you can take most of the time a 10 cent gain on it, and usually you'll get that between 12 and 1 o'clock. You'll be able to close your trade out, most of the time for 10 cents. Now, if the market's moving away from your trade, you can get that much quicker. I've actually gotten 50 cent 50-cent premium and close the trade for 10 cents within less than an hour. And that happens as long as everything is working in your favor. Okay. Now, if you want to take a 5-cent gain, you're going to wait hours for that. You're gonna wait probably until 3 o'clock before you can get a 5-cent exit on your trade, and it's that 5 cents is just not worth it if you're going to get out anyway. You might as well just let it expire if you're going to do that. All right. Expiration for wider trades and getting the direction right. If only using a vertical spread. So it's okay to let it expire as long as you understand that you don't want to let a very profitable trade go against you, especially towards the end of the day, because a lot of reversals happen at the end of the day, and so you want to keep that in mind. And I have a chart here that shows just that. And the thing is, and I wanted to share that chart because this happens a lot. Okay, it happens a lot of the time, right? So you want to be cognizant of the fact that when a market is moving in one direction, it tends to overshoot and then come back very aggressively in the other direction towards the end of the day. All right. So let's talk about stop loss and rolls, right? And so if the market immediately moves against the trade and continues after that trade initiation, you want to figure out a way to get out of that trade because. And this is a good example of what happened yesterday, and I'm gonna, some people will listen to this later on. So yesterday was Monday, October 26th. Okay, so look at what happened on Monday, October 26th. If you're interested in understanding the dynamics of a market, where you put on a put credit spread, and all of a sudden your put credit spread is doing great, right, for the first half hour, and then all of a sudden the market tanks and it continues to move down, and it breached those areas. But the thing is that, and I got out of that trade, I rolled it, okay, and what happened was the market came right back up, and it was above the breached area or the short leg, which is the most important, and you would have gotten out of that trade at expiration, for a max gain, okay, but you just don't know, right? So, and I've had trades go against me, breached, and continue moving and close at the lows of the day. So you have to be, you have to keep in mind is manage your trades based on the worst conditions, okay? So you don't end up with a max loss. All right, and so so if that happens, you want to figure out how to get out of that trade. And I also use in my trading support and resistance areas, and I can tell you, like today, the resistance area of the SPX is basically 3,400. And if you look at where the market has been all day today, you can look at the market and see that there's a huge amount of resistance at 3,400. And it's important to understand support and resistance, especially with 0 DTE, because you want to know where your pain points are. Okay, and so if you have a pain points and where it's acceptable to put on your trade, right? So today was a 0 DTE trade, and you had a call credit spread, let's say at 3,420 or 3,430, you'd probably be fine. Because every time the market went up to 3,400 today, it reversed back down, right? So that's a good example of using, support and resistance areas in your trading, so that you have more confidence in what's going to happen in the market, even though it could break. But generally speaking, the market respects those support and resistance areas, so you want to use those and have knowledge of using support and resistance areas. All right. Okay, so let's talk about rolling. Before, I used to say, well, no rolling, just take the loss, But however, with a put credit spread in a generally trending up market, okay, you could find ways of rolling it. And so the key to that is that you want to roll that trade prior to it being breached, okay? The ideal area is 10 points or higher in a volatility space like we are today, around 25 to 30. Okay, so you wanna roll that trade where you can actually get a credit for it, rolling it out, let's say 7 days, and giving it distance from the market. Now, what happens if you get within 5 points or even it being breached? For that same roll, you're gonna actually pay instead of getting a credit. Okay, and that happens very, very quickly for the same amount. So you want to, if you're planning to roll it early, roll it, before you get within 10 points of it being breached, and that way you're able to manage it later on. Okay, and then what I do is I roll it and then I manage it as a 7 DTE trade. Now, what's the risk of that happening? If you do use rolls on 0 DTE, you're going to end up managing more trades, right? Because you're gonna send it out 7 days or 5 days or whatever, and then you're going to have more margin accumulating the use of, right? And so it may restrict you from doing other trades because you're going to have more of these rolled 0 DTE trades out, and it's going to cause problems down the road. Okay, so that's a risk that you have to keep in mind. Okay, when you're rolling these out. Okay, Dwayne has a question: is there advantage to rolling versus cutting loss, or just putting it on another spread? Dwayne, I can tell you that the most favorable way is really kind of to cut your loss and move on. Okay. However, if you wanna try to save it, there are ways of rolling it, as I mentioned, and you roll it prior to it being breached. Then you do have the advantage of not taking that loss and possibly even rolling it for a credit. But then keep in mind, you're going to have to manage that trade later on, and it's going to consume some of your margin in your account. So you gotta be cognizant of how much margin you have, and that should be part of your trade plan, and not to trade so many of these spreads. So if you do roll it, you're not sitting on very, very little margin to be able to even roll it in the future. Okay, so keep that in mind. On call credit spreads, I can tell you those are a disaster to roll, and I really don't recommend it, because just think about it. In a situation where you have to roll a spread, a call spread, let's say, the market's already moving higher, and when markets tend to move higher, they continue to move higher, and so you're going to be stuck with a call spread that you probably rolled not too far away from the market, because you're going to have to probably pay for it, and then add a put spread on there to compensate for the cost of that. Okay, and so and then you're going to end up mitigating or managing that trade, because the market's going to continue moving higher, and this is what typically happens. And so I really wouldn't recommend rolling a call spread in this situation. Okay, and it really is because of premium limitations, because you just get less premium as the market goes higher, because volatility goes lower. Okay, those are just the dynamics of the market, so keep that in mind. Okay, so let's talk about actual trades. This is a trade that I did a long time ago, but this happens. This is just a great example of what occurs in a market. Okay, so I took and this is, I trade a 5 wide here, right? And I took 40 cents premium on this one. All right, and okay, let me answer this one question. Do you ever roll the same 0 DTE contract? Here's from Maximus. Do you ever roll the same 0 DTE contract, or do you always roll it out to 7 DTE? No, sometimes I can roll it out to 5 DTE or 3 DTE or 8 DTE or 9 DTE, right? So, but I generally do it for 7. I do it around 7 days. That kind of gives me You don't want to send it out way too far or way too little, right? But it gives you the right amount of time, because the option expiration rate falls very, very quickly within 5 days. And so you want to make use of those 5 days of theta decay, if you're going to roll it. And you don't want to send it out too far in expiration, because the market can do anything. So you want to manage that, okay? Good question, though. Great question. Okay. So I put on this was a call spread at 40 cents. Now, the market did move against me, okay? And it went up to this area here. And, the premium was now 70 cents, and it was around 10 o'clock in the morning. And so you can see the initial, it was great, right? The market went down, and then boom, it reversed right back up to this area. Now, I had identified this area, of resistance here earlier in the day. And so I knew that there was resistance here, and I was ready to get out of this trade and actually close it. But you can see here that resistance, was, several times it tried to break it until the very end of the day, okay, when the market went way up. So what did I do? Actually, the market went down after that, and I closed the trade around 10:45. So I was in that trade very, very short time. Now, even though the market, went down, direction, made a difference in this trade, all right? And so you want to use, direction in the market to your advantage if you have it, okay? So I did get out at 10 cents, made 30 cents on the trade. Now you can see what happened during the rest of the period, during the rest of the day. The market, if you're waiting for expiration, you're going to be sweating bullets. If the market goes up into this area, and it was 29.92, and I used futures, by the way, to trade, right? And so it's similar to the SPX, but you can see here that, basically a very profitable trade turned into a very non-profitable trade. And the market, the SPX, was around 29.90, okay? So 5 points away from my short, reaching my shorts, call. And, that's a lot of stress, and you could have had a loss, a pretty big one here if the market kept going higher. And so the issue is, the longer you're in a trade, the more risk you have, especially when you have a profitable trade already. And so you want to keep that in mind when you're trading. If you do have enough cycles for your PDT, enough trades, use it, and wait a couple days, and it's going to reset again. Okay, so you want to keep that in mind. Okay, so this is the 1 minute chart I'm using here. I want to share, show it to you in terms of a 5 minute chart. And here was here's where I put on the trade, and then later on, again, it moved much higher. And so let's see here. This is where I put it on. And so what happened here? So as the market, went up here, what I used too is RSI, okay? And so, I was watching this, and the market continued moving up, but in this case here, it lost momentum. And so I have a little bit of confidence here that the market would have reversed, and actually that's what it did, okay? And so here's the same, area for the 5 minute. Now this is this area here is implied volatility, okay? And so you can see at the beginning of the day, boom, you have a spike in implied volatility, and then it kind of wanders down, okay, all throughout the day until around 4:30, where it picked back up again, and the market went down, and then volatility went higher as the day went on, okay? So I just want to share, a little bit of the charts. And how these zero DTE trades function, and that covers it. So one more question from Maximus. You mentioned not to roll call spread. What else can you do if it stays against you and doesn't come back to take a profit? The best thing that you can do is, as the market is moving up against you, take a loss. Just close that trade, okay? You're gonna end up taking more of, and I'm telling you from my own experience, you're going to end up taking more of a max gain, more than a max gain, many times if you don't close that trade for a loss when the market's moving aggressively higher. Okay, it's very, very difficult to mitigate those trades, and so I mostly put on put credit spreads just because of the flexibility that I have in managing it one way or the other. And I tend to stay away from call credit spreads. However, in the zero DTE rule world, you really should be using both, right? Okay, so that covers it for today. I hope this was of value to you, and go back, review it. I have more than 2 years experience trading these things, and I've been through everything you can imagine on these trades, right? And if you do have a question, you can reach out to me at any time. With this type of trading, minimum size account, you really don't want to have less than a $3,000 account to do this, and trade 5 wides in that account, to do that. All right. But ideally, you want to have an account that's at least 20 to 25,000 to do these trades, so that you can trade them small and learn as you learn, and trade with small positions, so that psychology doesn't affect you. Okay. Hey Maximus, I'll comment on your comment, okay, about that. I saw it, I just haven't been able to get to it, and I'll get to it. All right, guys, thanks again, and have a great rest of the week. Appreciate it.